Charmaine Felacelda,
Ramil Giabroso,
Marjay Riva,
Kyla Jane Morales,
Rona Hinunangan,
are your Group 11.
Hi everyone! So, I am Ramil Giabroso and I will be discussing the operating and financial leverage. Operating leverage, a cost accounting formula that measures the degree to which firm or project can increase operating income by increasing revenue. A business that generates with sale with high gross margin and low variable cost has high operating leverage. So, operating leverage, as what I have understand, it is a financial ratio that measure the sensitivity of a company's operating incomes to its sales. The financial metrics shows how a change in the company sales will affect its operating income. So companies with high leverage must cover a big amount of fixed monthly irrespective of whether or not they sell any units of product. Low operating leverage companies may have a cost that modify direct with their sales but have lower fixed costs to hide monthly. So I have here an example of a operating leverage. So a company sells 500,000 products for a unit price of $6 each. The company's fixed costs are $800,000. It costs $0.05 variable cost per unit to make each product. So, sa pagguha sa operating leverage, na formula nga gamiton. So, degree of operating leverage minus unit quantity times contribution margin divided by unit quantity times contribution margin minus operating fixed cost is equal to 500,000 times $6 minus $0.05. So, ang kining 500,000 mo na siya ang unit quantity. Ang kining $6 is mo na siya ang price sa product. Then, ang 0.05 mo na siya ang variable cost per unit. So, i-divide mo siya sa quantity product, unit quantity, which is 500,000. I-times mo siya sa contribution margin, which is price minus variable cost per unit. So, ang price is $6. So, i-minus mo siya sa variable cost per unit nga 0.05. Then, i-minus mo siya sa fixed cost nga $800,000. So, ano siya is equal to $2,975 divided by 2,175,000. So, i-divide mo siya, makakuha na ka sa degree of operating leverage nga 1.337 or 137%. So, mo na siya ang imong degree of operating leverage. Financial leverage is also known as a leverage or trading on equity, refers to the use of debt to acquire additional assets. The use of financial leverage is to control a greater amount of assets or by borrowing money will cause the returns on the owner's cash investments to be amplified. Financial leverage. So financial leverage is a story of assets and the return on one side. And the way the assets are financed on the other side. So the concept of financial leverage can be applied to companies, investments, portfolios, and even to the house you own. Example of financial leverage. So we look at a company or a factory with 1 million assets such as buildings, inventories, machines, and etc. These assets generate an annual income of 100,000. The return on asset is therefore 10%. 100,000 in net income divided by 1 million in assets. How are these assets financed? So, let's assume the assets are financed full by equity, shareholder capital. So, 100,000 net income divided by 1 million in equity is 10% return on equity. So, that's the example of financial leverage. Let's proceed on my second topic, which is the leverage and the income statement. Operating costs are associated with the maintenance and administration of a business on day-to-day basis. Operating costs includes direct costs of goods sold or COGS and other operating expenses, often called selling, general and administrative or SG&A, which includes rent, payroll, and other overhead costs, as well as raw materials and maintenance expenses. So, ang operating cost di ay is mauni ang mga expenses nimo sa pag-operate sa imong business. Ang direct ra nga expenses. If moingon taog direct kanang naas imong factory nga operation. So, example of operating cost are insurance, legal fees, office supplies, rent, maintenance supplies, salary and wages, or other than direct labor for production employee. Capital cost is the required return necessary to make a capital budgeting project, such as building a new factory worthwhile. When analysts and inventors discuss the cost capital, they typically mean the weighted average of a firm's cost of debt and cost equity blended together. So, capital cost. So, if muingon taog capital cost, mao ni ang imong mga gasto sa paghimo, sa pagtukod o sa pag-invest nimo sa ka-business. Mao kibali ni imong target nga amount of money nga mauli nimo aron di ka malugi or di man malugi imong business. So, example of capital cost. Purchase of fixed assets such as new building or business equipments, upgrade to existing facilities, and the acquisition of intangible assets such as patents. Short-run cost is the cost price which has short-term inferences in the manufacturing procedures. These are utilized over a short degree of end result. So, ang short-run cost is mao na ang cost nga dili na nato mabalik og gamit kay ato namang gi ngadto. Like for example, payment of wages, cost of price of raw materials, and etc. It happens in a short period of time, like in the process of manufacturing goods. Variable cost, a corporate expenses that changes in proportion to production output. Variable costs increase or decrease depending on a company's production volume. They arise as production increases and fall as production decreases. Variable cost, so ang una jud nato masud sa atong huna-huna ug unsa ang variable cost is cost of raw materials and packaging. So unsa jud ay nang variable cost. So ang variable cost ay is an expense in which mo increase or mo decrease depende sa capacity that the company can able to produce. Example of production cost has higher expense, then the variable cost can also increases. Same thing, and if the production of goods decreases, then the variable cost also decreases. So mao na siya ang variable cost. Fixed costs, a cost that does not change with an increase or decrease in amount of goods or services produced or sold. Fixed costs are expenses that have to be paid by a company independent of any specific business activity. So, let's proceed to fixed costs. So, fixed cost is different from variable cost, since variable cost can increase or decrease. That fixed cost is a cost that already fixed, that the business entity are liable to pay a certain amount of money, which is independent for any specific expenses of the business in regards of their activities that need to pay the company. So, mao na ang fixed cost. Just for example of a fixed cost, you pay rent to hold a class in a room which costs you 50,000 with a maximum capacity of 50 students. As long as you hold class within 1 to 50, your fixed cost will be 50,000. However, what if your student suddenly become 60? Either you decide to rent a bigger room, which rent will differ, or rent another classroom, which in turn change your fixed cost, as it is only fixed with relevant range. So mo na siya ang example sa fixed cost. Long-run costs are accumulated when firm change production level over time in response to expected economic profit or long-run cost. Long-run cost is cost siya nga nag-involve og taas nga term sa pag-process sa mga goods, which is liable ang company to pay the certain amount of money to fix the cost over the long period. Example of long-run decisions that impact a firm's cost include changing the quantity of production, decreasing or expanding a company, and entering traditional and revised income statements. Aligan Manufacturing Company, year ending December 31, 2004. Traditional income statement format. So, sales mo na sila ang operating leverage, o ang kini pong mga earnings before interest and taxes or EBIT mo na sila ang financial leverage. So, sales has $5 million. Cost of sales has $2,500,000. Ang selling, administrative, and general expenses na ay $1,500,000. So, i-add ning cost of sales o ang selling, administrative, and general expense na total nga 4 million. So, i-minus nimo siya sa $5 million na akay earnings before interest and taxes, EBIT nga 1 million. Anya, ilas ang interest expense nga 250,000 na kay total nga 750,000 nga earnings before taxes. Anya, ilas na mulas na pagkag income taxes nga 40% rate nga 300,000 minus nimo siya na kay 450,000. nga earnings after tax or EAT. Anya, ilas na pod nimo ang mga preferred stock dividends nga 150,000 na kay remaining nga $300,000 nga earnings available to common stockholders. So, earnings per share or EPS nga 100,000 shares. So, i-divide nimo ning $300,000 sa 100,000 shares, makakuha ka og $3. So, revised income statement format. So, same ra gyapon ang paagi nga na. So, revised income statement format, sales nga $5 million, less variable operating costs nga $3 million, o ang fixed operating cost na nga 1 million, i-plus nimo sadya na kay total nga 4 million. So, ilas na po di mo sadya sa $5 million minus 4 million nga kay 1 million nga earnings before interest and taxes or EBIT. Ilas nimo sa fixed capital cost or interest nga 250,000 na kay total nga na 750,000 nga earnings before taxes or EBT. Last na pod ka og income taxes or variable nga 40% rate, 300,000. So na naman kay 450,000 nga earnings after taxes or EAT. Last na po nimo sa fixed capital cost or preferred stock dividends nga 150,000. So na kay total nga $300,000. Mao na ang imong earnings available to common stockholders. So same ra gihapon, imo ning ang 300,000 i-divide mo sa earnings per share naka $3. Thank you. Semi-variable cost, also known as a semi-fixed cost or a mixed cost, is a cost composed of a mixture of both fixed and variable components. Costs are fixed for a set level of production or consumption and become variable after this production level is exceeded. If no production occurs, a fixed cost is often still incurred. So, semi-variable cost or gitawag na siya og mixed cost. So, kibali mo qualify siya as variable cost and fixed cost. So, ang mixed cost is partly fixed and partly variable. For example, electricity or utility cost. So, you are charged a fixed rate for using a base amount, and then you pay an additional variable charge for any usage over the base amount. That's why mixed costs.